Give us a price and the context here, Minmin.
So according to the terms of a deal that Bloomberg has seen, initially Xiaomi was planning to sell just 750 million shares, but we're learning from sources that Xiaomi is upping that to 800 million shares, selling at about 53 Hong Kong dollars a piece, which is slightly below the midpoint of its marketed price range. And the company plans to use these funds to invest in R&D, to expand their EV business. And obviously they're taking advantage of this time when their share prices has flipped almost 3 times over the past year. Investors liking the fact that the company has been able to replicate its success in the smartphone market in the very crowded EV space as well, because Xiaomi has been investing heavily into EVs. They are raising their delivery target this year after posting the highest revenue growth since 2021. They are expanding the scale of the second factory that they are planning in Beijing in a bid to ramp up production. So longer term, Citigroup has said that this will be good for the company, helps it to deleverage, but shorter term, it could put pressure on the share prices because of the dilution.
Minmin, I mean, there has been some hope that Hong Kong deal flow is actually going to pick up a little bit this year. Just lay out how important, this latest development with Xiaomi is for that deal flow and that pipeline, and whether or not this is a focus on Chinese tech and the optimism specifically around that, or whether this is more broader about improved consumer sentiment, perhaps.
Yeah, probably a little bit of both. So the Xiaomi deal, obviously the size of it is very big, and it would take the total share sales volume this quarter in Hong Kong to the highest level we have seen since late 2021. And a part of that is because the Hang Seng has been outperforming global indices. It's up about 20% so far. That's attracted inflows from global investors. It's reviving hopes that maybe more companies will look at what BYD and Xiaomi is doing and think about tapping the equity markets for funding as well. And then you add to that what the CSRC has been doing, encouraging more Chinese companies to list in Hong Kong as opposed to in UK or elsewhere in the world. They have been accelerating the approval process, increasing the connectivity between Hong Kong and mainland markets. So all of these factors help, so much so that actually so far this year with the IPOs, we've seen pretty heated demand from retail investors that the Hong Kong Securities and Exchange Commission actually also revived this cap on margin financing as well. Looking set for a bumper year on when it comes to Hong Kong deals.